Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors cited GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the cited GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what we saw overnight. Global stocks finishing mostly lower. Stocks on Wall Street broke a three-session run of record closing highs as Federal Reserve Chair Jerome Powell tempered expectations of interest rate cuts. The Nasdaq led declines as tech stocks faltered. Apple, Amazon and Microsoft among those falling. Shares of Nvidia retraced the previous session's gains when the chipmaker said it plans to invest up to $100 billion in OpenAI. And OpenAI, Oracle and SoftBank have announced plans for 5 new AI data centers in the US to build out their ambitious Stargate project. Micron Technology shares gained around 3% in late trade after having reported after the bell with the largest US maker of computer memory chips, giving an upbeat forecast for the current quarter, helped by demand for AI equipment. Computer chip equipment maker ASM International cutting its revenue target for the second half of 25 ahead of an investor day, saying it expected demand for its most advanced machines to drop towards the end of the year. And shares of consumer health company Kenvue rose after having hit a record low on Monday when President Trump linked autism to the company's pain medication Tylenol when taken by pregnant women. Analysts expect the stock to recover, citing absence of new scientific evidence from the White House. Well, US Federal Reserve Chair Jerome Powell has said the central bank needs to continue balancing the competing risks of high inflation and a weakening jobs market in coming interest rate decisions, saying near-term risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation but leaves us well positioned to respond to potential economic developments. Our policy is not on a preset course. He spoke following comments from Fed Vice Chair of Supervision Michelle Bowman, who has pressed for aggressive cutting, saying it's a lot easier to support the labour market by lowering the federal funds rate than it is to fix it after it's broken. Well, the latest economic outlook from the OECD has found global growth is holding up better than expected and is now forecast to slow only slightly to 3.2% in 25 from 3.3% last year. It says the full impact of US import tariffs is still to be felt as AI investment props up US activity and fiscal support cushions China's slowdown. The OECD forecasting US economic growth would slow to 1.8% this year, while Australia's growth forecast remains unchanged, also at 1.8%. US Treasury yields declined following Jerome Powell's cautionary interest rate commentary. The yield on the 10-year down at 4.11%, the 2-year around 3.59%. And the US dollar index, little change. The Aussie trading at 66 US cents. Oil prices rose after a deal to resume exports from Iraq's Kurdistan stalled, pacifying some investor concerns that the restart would lead to a global oversupply. Brent crude futures up 1.5% at $67 a barrel. Copper's up marginally. Iron ore off around 0.5% at $106 US a tonne, and gold again pushing to a fresh record high. Spot gold up 0.5% at $3,763 an ounce, and Bitcoin trading lower at around 112,000 US dollars. Let's get across what we're seeing on US markets. I caught up earlier with Peter Cardillo from Spartan Capital and spoke about what we heard from Jerome Powell.
Well, you know, I was pretty much surprised over the fact that the market fell but didn't really fall into a panic selling mood. The Fed laid out several points here. The first point that I think could have been detrimental to the market was the fact that he said that stocks probably fairly valued or overvalued. And so we saw the market basically take that into stride. And of course, he did, to a certain degree, he was dovish, but he certainly was he certainly used a lot of cautiousness as well. And I say that because he basically said the Fed monetary policy now is in a good place, and we see no rush in lowering interest rates, which means they're going to take their time, and which simply means that the Fed is concerned about inflation, and he alluded to that. He also alluded to the fact that the labor market has weakened, and so that takes us to another version of his speech, and that is stagflation. So that usually is a negative factor for the market, but yet we saw the markets pull back, but in a very orderly fashion. And I think the reason for this is that we are approaching the end of the quarter. Generally speaking, this week and the last days of the quarter invite institutions to readjust their portfolios. And then not too far in the distance, we have third quarter earnings. So I kind of think the market is probably not going to overreact to Powell's comments about the market being overvalued, but take a wait and see attitude until we get the earnings season in full bloom.
Peter, is your expectation equities are going to continue to run to the end of the year on the prospects of rate cuts and also, obviously, that AI trade?
Yes, I think so. There's just too much enthusiasm in the marketplace. And, it sort of takes me back to 1996, 1997. And while over the past 7 or 8 months, there's been a lot of talk about AI and certainly a lot of money being thrown into the sector, we still probably have not reached levels that we saw in 1999 or let's say 2000, when the dotcom bust, really put Nasdaq put Nasdaq down to a crawl, and obviously it was a disastrous 2 years after that. But I think we have room to go, and I think earnings again. I said that just a little while ago. I think the market is waiting to see what third quarter earnings shape up to be, and also the fact that investors are anxious to hear what corporate America has to say about tariffs impacting the business or impacting earnings, and that'll be the key.
Meanwhile, Peter, precious metals, gold continue to hit record after record. Silver is following. What's stopping it at the moment?
Oh, indeed. And of course, I think we're probably headed to 41.50 by year end on gold, probably $50 on silver. There isn't much we could say other than the fact that there are a lot of uncertainties out there. We spoke about stagflation. We spoke about possible lower rates. We still don't know the full effects of tariffs. And still major deals have to be made. And so that's a lingering problem for the market. And all of these known factors are just going to create an even bigger appetite for the precious metals.
What are you seeing with the US dollar at the moment? Obviously, given it has fallen, that is also broadly supportive for gold. But where to now, do you think, for the US dollar?
I think that the US dollar, is probably headed lower. It has shown some stabilization here over the past 2 months, but I don't think the unwinding of the carry trade, nor do I believe the full effects of the tariffs have yet to have a major negative impact on the U.S. dollar. I think we go lower. In terms of the dollar index, I'm still looking for about 92, 93, which is about 5 cents, 5 points from the present level.
And Peter, what's your view on the energy sector at the moment with those oil prices? Are you expecting them to climb from here or go in the opposite direction?
No, I'm neutral on oil prices. We saw a pop yesterday, a little bit today, but I don't think we're going anywhere. Again, there's uncertainties over what how tariffs may impact global growth. And speaking about that, the OECD raised the U.S. and global economic activity forecast, but they also warned that while 1925 obviously will escape serious problems for tariffs, that in 2026 that's a different situation. And so I think the oil market, like the gold market, is looking forward. And in spite of the fact that the United States continues to drill at full speed ahead, in spite of the fact that OPEC Plus made a token increase in production, basically trying to defend the price of oil without contradicting or going against the wishes of President Trump. I think that the real supply and demand factor is still pretty much questionable, and so I think we won't see a major decline from these levels, but I don't see a major increase.
Peter Cardillo from Spartan Capital getting across what he's seeing on markets and more broadly globally at the moment. Let's focus now on where we're likely to begin. We are expecting a lower start on the ASX there. SPI futures off by around 1/3%. We'll get right across that in just a moment. Stay with us.